Well, good morning, everybody, and welcome to day 3 of the NWR Small Cap Conference. Thanks very much for joining us. Kicking off today's session this morning, we have MSL Solutions. MSL is a SaaS technology provider operating in the sports, leisure, and hospitality sectors. Some of the world's most iconic stadium and large event venues, sports and entertainment companies, and professional golfers associations rely on MSL Solutions every day. This company creates the systems that connect every department of a business, from point of sale and membership to marketing, and they provide real-time visibility on staff levels, customer engagement, profit and revenue. So presenting today, we've got Pat Howard. So Pat was appointed the CEO of MSL last year. Pat's got more than 20 years experience at executive level across property, retail and the sports industry. He's the co-founder of RX Management, which manages 17 pharmacies. He was previously the Chief Operations Officer at Cromwell Property Group. And Pat is also a former Australian Rugby Union international. So with that, I'll just remind everyone that you can submit questions via the Q&A box at the bottom of your panel. And with that, I'll pass it over to you, Pat.
Thanks very much, Tim. Sorry, I've got a little bit of feedback. It's a little bit earlier up here in Brisbane, as they all say, we're an hour behind or a decade behind, depending on your point of view. So thank you very much. And for those that have been here for a couple of days, thank you to your third day. Hopefully we can kick you off in the right way. As Tim alluded to, MSL Solutions, we are a SaaS technology platform. We've got bases in 6 offices, but effectively a base in the UK, Denmark, a business called Golfbox, and then an Australian business. We have a presence in stadiums and arenas, pubs and member clubs, sporting associations, golf clubs, golf federations, marinas, and effectively anywhere where you go to a venue and you buy something, we give you the user point of sale to increase the analytics, understand your expenditure, understand the rewards mechanisms to be able to make sure it's a very tailored customer experience, and using the point of sale as the leisure as the point to do that, but extending that point of sale into your own devices as you're seeing today, but the analytics for the operations guys to be able to run it. So it's payment provider, contactless entry, ordering and payment, operational data in the palm of your hand, trying to drive that. And in a post-COVID world, we're seeing that you're going to have to make more money per customer on a lower cost base. So for those of you in Victoria, there is some genuine pent-up demand, but we're seeing obviously still restrictions in place and how many people can come together, and venues are going to have to be able to drive that revenue that way. 55% of our business is venues. 45% of it is golf. And for anyone on this call that has a handicap, you are an MSL customer. GolfLink Partners, we run GolfLink Partners, and through Golf Australia, our largest contract, and that's out to 2025. So both from a golf perspective and a venues perspective, we have SaaS technology providers to be able to drive that revenue. I know you've got a lot of meetings today, so look, the key take-homes that I want to get across, as Tim pointed out, we've been in place, that's myself, the CFO and the chairman, for around about 14 months, and the turnaround from Q1 FY20, we're incredibly pleased by what's been achieved. We're EBITDA positive for the second half of FY20, and that excludes any government assistance. We're cash flow positive for the calendar year from January 1st to September 30, both from an operational perspective and the overall cash position. From June to September, Appendix 4Cs, which have obviously been lodged, our cash receipts are up by 27%. And look, it reflects those long-term contracts we have in place with Golf Australia, Stadium Australia, which you'll know, the MCG, the Gabba, 14 to 20 English Premier League clubs, and in Australia particularly, we have a very strong pub and club space. They're all venues. You all have to sit there. You all have to be able to order your food, your drink, maybe your merchandise, depending on the customer, and be able to do that in a way that the customer is known. So it's not necessarily on a transactional base. It's far more that SaaS provision. We do have some transactional income, and I'm sure you can ask me about that later. The market cap, we have been bobbling around 7 cents, 8 cents for a fair amount of time, which is 1.3 times our annualized recurring revenue. And I think for any business, we've all been tested during COVID, and recurring revenue has stood up and actually grown through FY20 off that lower cost base. One of the biggest goals that we have set ourselves over the last 12 months was for recurring revenue to exceed OPEX on a 3-month trailing basis. And when we get to the financial slide, you'll see that's been achieved and consistently been achieved over the last quarter. I think to get ahead of another conversation, this is one of our customers, Arena Racing in the UK. This is about 3 or 4 months ago. I appreciate the UK has gone down into lockdown again, but as the Victorians on this call appreciate, you do come out, and there'll be some genuine pent-up demand, but it's showing how much innovation is happening. Point of sale used to be line up in a shop. You'll do your order and you'll find your seat and it'll come to you now. It is absolutely, will be coming off your phone, off your device. You'll be ordering, you'll be tailored to, it will know if you're gluten-free. It will know if you have some other ordering preference, how often you go, and it'll give the greater engagement to the customer and greater insights to the operations venue. We've also seen a reasonable amount, no more, a lot of innovation come through the last quarter. By that registration process then holds your data to give you greater insights to drive greater revenue from that lower cost base. We might have 20 people, 50 people, 1,000 people, or as the AFL did at the grand final of the Gabba, you still are going to have some sort of restrictions for people, but you can drive greater revenue from those lower cost base, and MSL solutions help you do that. Just to drift into the other side, our GolfLink partners, golf has stood up incredibly well during COVID. I think for the Victorians on the call, you're one of the few places in the world where golf was not allowed. It's some pretty unique part of Victoria, and we've seen golf really thrive through that period. And to a certain extent, even in the US, still it is very, very difficult to get on a course. We have a very strong presence in Australia. We have about 20% of the market share here. In Europe, particularly in mainland Europe, North mainland Europe, we have a really strong dominant position in that part of the world as well. And we are one of the few companies in the world that has done world handicapping, bringing 1.5 million golfers across to a new world handicap in the first half of this year. For those that don't know us, we have some very iconic customers. You can see Wembley on this slide, the MCG, the R&A, which is obviously Royal and Ancient out of the UK, Golf Australia, but even the hospitality leisure, the Pizza Huts in the UK, Merivale, Justin Hem's group based out of Sydney, the Wet and Wild, and sort of Top Golf based out of the Gold Coast, and some of those, and the big membership organisations both in Queensland and New South Wales. We have a strong base there, plus a significant amount, nearly 275 golf clubs across Australia, which, if there are golfers on the call, there's effectively ourselves and another big player called My Club, and they're the two leaders in the area. So we have a role with investors, venues, integrators, partners. The majority of our products are IP. We do have some reselling components on products that we believe can only enhance the customer experience. Just reflecting back on 2020, and I'll remind you, current management were only there for the last 3 quarters. We do have a cloud and on-premise solution. Our recurring revenue really stood up during this period, 71% recurring. We did close down some products, so some of our unprofitable lines were closed down, which did affect revenue. The second half of the year, we were EBITDA positive, excluding government assistance, which I mentioned earlier, but we had a $2 million year-on-year growth from FY19, the back half of FY19 to the FY20, and our cash position is very, very strong. We still only have 5% penetration in the Australia-New Zealand region. We believe there's still great organic growth in that as we streamline our products. But particularly in FY20, as you would appreciate in the role, you've come in to do a turnaround, and we still believe that this is a great turnaround story. that the changes made in FY20, the full year benefits still haven't been seen, and we anticipate anywhere between 5 to 10% decrease in operational run rate for FY21 as well. The last dot point is opportunity to grow a modest valuation, 0.1 times the enterprise value over recurring revenue, and we do see ourselves as very good value currently. And so we'll go through the process of raising our profile at this point. 2 slides on our products in the golf space for the golfers on the call. We have golf management systems, golf lesson booking systems, tournament management, and as I talked about earlier, world handicapping. We're the only company in the world that delivers world handicapping, golf management systems, and tournament management systems. To give you some perspective on that, our competitors, My Club in Australia, they do not do world handicapping and have to link into our systems to be able to allow your world handicap to follow you. Golf Genius, a big US-based business, do world handicapping and do tournament management software, but they don't do your golf management software. So when you go and play your round and being able to book your system in, they don't do that part of it. So we are a one-stop shop, and as far as we know, I know competitors also offer that full end-to-end solution. In regards to our venues, we've talked about our point of sale system, and I thought Tim did a very good job in trying to understand or explain that full integration, understanding how point of sale can understand those revenue drivers, tailor that experience so that you understand your inventory, understand your workforce, understand your spending habits, understand how often you go, your ability to pay by points, your contactless entry, and then extending that point of sale into your in-seat ordering, your at table, your click and collect, and give you analytics on top of that. We have our own IP, but we also integrate in with products such as new providers such as Me and You. So we're making sure that there are not barriers to sale here by making sure that we are agnostic, we do integrate in, but we also want to be able to say to a venue, we can give you your own click and collect and in-table order, and you don't have to go to a delivery. You don't have to lose that margin to some of those Uber Eats if you don't want to, and we can provide you that solution. There's some advocacy here. ASM Global, the top one, which I will drill in, they operate 300 sites in Australia, New Zealand, and Asia, and are huge advocates, and we've done deals with them at Perth Arena, Brisbane Entertainment Centre, and the ICC in Sydney, and to pay Christchurch Convention Centre just in the last year, to name a few. In terms of growth, MSL connection platform, and we were in survival mode very much earlier when we came on, and this was a great turnaround. We are now got through that period, and we see there's really 3 opportunities to grow. There's the organic growth in the venue side in Australia, New Zealand, and Asia, through our ability to really penetrate that. Obviously, the UK, we'll wait and see and play the waiting game on how that comes through, but I think we all believe the UK will come good. It is only 18% of our margin. We're already using the time to convert a lot of our annual payments to direct debit in the UK under monthly payments. We see some real benefit in there. In terms of golf, the strategy is obviously going to go to North America. The USA and Canada make up 60% of the market. Previous management really likes setting up new offices in those locations. I won't be doing that. I think it's a cost-based expense that you don't want to be able to do, whereas I would much rather partner and utilize the fact that we are one of the few companies in the world that can do that world handicapping, tournament management, and golf management, and there's been some genuine interest in partnering with our solutions. We've also announced some deals with Capture, Me and You, OpenPay, to really give that all end-to-end solution. So your payment structures, your point of sale solutions are really a tailored response and can give you that all-in-one delivery. I'll just quickly drill into the financials. As I pointed out earlier, we're very strong in making sure this is a sustainable business. In FY19, there was a $5.8 million loss, and there was a significant turnaround to $0.9 million loss in FY20. Most of those were contained in that first quarter. So we've made sure that we're focused on profitability and really delivered that in the second half of FY20. The chart shows that we've got ourselves over that 100% recurring revenue to OPEX number. And we've seen that as a real driver of cost efficiencies, but also new sales wins, the ASM Global we talked about earlier, and every one of those sales has a recurring revenue component. To give you a little bit of a drill down into our payment cycles, you're often asked, what is the payment structure? As with many businesses that come from small beginnings, it was very agile in the early days. There were annual payments dominating it, but we have converted a lot of people, particularly in this, to convert to our customers the billing of quarterly and monthly to actually help their own cash flow. And we've converted a lot of people to direct debit to do that. So that has been an exercise that's been very handy for our customers to convert to monthly. And obviously, we're really happy to have a far more smooth payment cycle. In saying that, we do have a significant amount of our UK customers still on an annual cycle. Our golf box business in Denmark is 97% SaaS. So all 97% of those contracts are locked in for FY21. Golf Australia, our biggest customer, they pay monthly. And our Infogenesis customers in Australia have a significant amount of those converted from annual to monthly. So we're really excited by where that's come, but it's just trying to give you an understanding of how we bill and our cash flow cycle. Going on to cash flow, and you will see in our last Appendix 4C, we're incredibly proud of where we've got to over this last year. The last Appendix 4C, which is the first quarter of FY21, was our best result in 2 years, generating over $1 million in net operational cash flow. If you compare that to FY19 and FY20's first quarter, you can see on the graph it's a significant turnaround from where the business has been before. We reported that we had $4.8 million at the end of September 2020, the first quarter of FY21, and we have $500,000 a facility that has not been drawn down. They're both overseas in Denmark and the UK. And we've also decreased our debt. Our borrowings decreased down to 1.1 million, or a 37% decrease in FY20. So our cash balance overall, our LVR overall, has all improved throughout FY20. These results on our earnings turnaround for FY20 have been displayed before, but it was a 4.7 million turnaround. And as I said, most of those losses were contained to prior to the management turning up. Whilst a very modest EBITDA profit in the second half of FY20, we're incredibly proud of it. It does compare like for the period before, which is a significant loss. And that's why the government subsidies, we could have reported $1 million profit in that period if we'd included the government subsidies, but we didn't. We wanted to make sure they were recorded as a normal item. The recurring revenue held up through that period really strongly. We took out a lot of unprofitable products. What that meant is it took out a significant amount of support people that weren't required for those products, and salespeople that weren't necessarily required afterwards for those products as well. And we had I inherited a very top-heavy management team, and that has been brought down so that the chairman, myself, and the CFO all take very hands-on approach to both the sales and operations. We've also seen, lastly, a significant amount of new products that have been able to be profitable during this period by extending that point of sale and expanding those sign-on periods during that product period. The corporate snapshot is included. That will be included in the deck. I think the biggest you'll see in April, May, we were heavily hit, I think, for a misunderstanding of the business, where they thought because stadiums were closed that we made money on the transactional activity, and we don't. It is possible that we may in the future look to do that, but the software as service is often an annual payment or a quarterly payment, and regardless if there were 200 events or no events, that software as a service is paid. And to give you some perspective, even in the UK right now, Liverpool have paid their full annual invoice of £200,000. And as I say to Liverpool, when we talk to them, it's still less than the weekly pay cycle of many of your top players. So we're not a significant cost to them as a consequence. The ability for the majority of those stadiums to pay hasn't been an issue that we've seen so far. Our shareholders, we only have 4 shareholders over 5%. They're listed in the bottom right-hand corner, and our exposure and details are in behind that. So look, that's your first 20 minutes. Hopefully I've kicked you off the right way on a Friday morning, and I will pass back to Tim for any questions.
Great stuff, Pat. Thanks for your preso. Plenty of questions coming, so let's hop straight in. First one, the new questions you've been winning so far this financial year, are they new clients to MSL or are they existing clients expanding their spend?
Bit of both. So golf has been incredibly good during this first quarter. We've repositioned our price point. My club are an expensive product, and our products, I think, have hit the sweet spot for many of those mid-tier golf clubs. So yes, we have a lot of new wins there. In the pub and club market, we have had a lot of success with new clients. The Young Hotel Group have owned 7 pubs in New South Wales. They're a big group. 5 Docks in Sydney is one of their biggest pubs, you may know, and they have used the time of COVID to really up their point of sale, extend their services. So we've seen those new sites. The biggest new arena was Perth, and that was an absolute new win. It does come down to a relationship with ASM that has been incredibly strong for us. They really like our services, and that is a 600 terminal site that runs through that Perth arena. So it has been a mix. In the UK, absolutely, it is existing sites looking to modernise for when they have to open up. And there's a far more conservative market over there at the moment. But Australia has been incredibly buoyant. And Tim, I know you've been in lockdown for a long period and you were very keen to get out. And we've seen a lot of pubs and clubs look to really up their servicing in what is a post-COVID world.
Not wrong at all there, Pat. We are keen to get out. So on to the next question. Can you talk about the level of confidence in generating revenue growth across each geography?
Yeah, I can. So look, I think let's work from UK back. So the UK is an unknown at the moment. We understand the complete risks to that business. It's 18% to our margin. We have already, and that is if nobody paid in the UK, and UK was an extensive lockdown. But we're already seeing that most of those businesses are finding new ways to operate revenue and where their way of collecting revenue. So they are working within the boundaries of what the UK is allowing. They are opening up their restaurants and using them as click and collect. So we are offering their services and in a very attractive prices to keep those businesses going. So we do believe the UK will bounce back, but it will be slow. Denmark is leading world handicapping. We are in 7 new tenders in Europe. They're using the winter for golf to open up and advance their world handicapping. It is an incredibly resilient business. It's not exponential growth, Denmark, but a fantastic, strong, resilient business that where we can take those products into different countries. We're the only business that has been able to use it in different languages. So Japan is the second biggest golfing nation in the world. Our ability to be multilingual is incredibly important to many of those countries, and we've been able to show that and demonstrate that we have leading edge, not bleeding edge technology. It works. It's really solid. In Australia, it's very buoyant. We are seeing a lot of growth in that venue space. The tenders are coming thick and fast. We are seeing both in the pub and club space, performing arts centres as they're opening up as well, further stadia. We all know there's a huge development happening in Sydney, and we are already in Stadium Australia as they redevelop. So we're very buoyant about the Australian and New Zealand market, and we look forward to taking some of our new products to Asia as well, where we've got some exclusive licenses.
Thanks, Pat. Probably an extension of that last question. Another one that's come in. Are you able to provide an indication around the size of your sales pipeline on an annualized recurring revenue or a total contract value basis?
Yeah, we can. And so, look, I can tell you for the end of this year, there is a pipeline of 5.6 million. So obviously it depends. And we try to do pipeline in a way that it is either we are shortlisted or above. So we know that we're in the mix there. We don't, just in case we hear about a deal, we don't include that in our pipeline. I've seen that sort of reporting before. So I think you got to be very careful on what is a pipeline. But we have opportunities in those spaces. So we qualify our pipeline into shortlisting, obviously into contracting and won but not invoiced. And that's our pipeline towards the end of the year. Obviously not all of that will be won. Some of it's competitive. Some of it, there might be 3 to 4 in that tender, and some of those tenders might even go over the December period and into January, February. But that's the number we have on our books, and that's what I'm driving the sales team. And I think to qualify our sales team, I have made some significant changes. People ask about, you lose a lot of staff. We find that the deals are 150 or 200,000 above. They are closed by your CEOs and your chairmans. They are the ones that are won by the pointy end of the deal. So those partnership deals are done there, and that's where myself and the chairman take a very strong role. As you heard, my background is strongly in sport. I work for Cricket Australia, Rugby Australia. I have a big sport background. My chairman is ex-CEO of eBet and started Tabcorp. So he's incredibly strong in the pub club space. I'm incredibly strong in the stadium space. The chairman of Cricket Australia sits on our board. And so we have a really strong duality in terms of complementary skill sets.
Sounds good, Pat. Just looking to the golf business, can you talk to the progress in expanding the World Handicapping Service to more countries, and let us know sort of what the biggest barriers are in that exercise?
Yeah, well, one of the great things for us is that we are in every tender. Because we have been able to demonstrate now across 9 countries successful launches. Golf Australia with MSL and GolfLink. So GolfLink is the business that you may be aware of, your golfer in Australia. We successfully the first company to do that. Every golfing country does put us on the tender. I haven't heard us miss out on one yet. What we find though, and I think you would appreciate this on the call, is that you will have a local tenderer, and we're seeing this. An example right now is we lost one in Slovenia, the big golfing mecca where it is Slovenia, where you were completely undercut by a local provider. So we do see that. But we also see those fall over. Recently, Spain went for a local provider that fell over, and that tender has reopened, and we're very confident of going back into that space and then going for a high quality product rather than the cheapest product.
Thanks, Pat. And is now an appropriate time to be looking at new acquisition opportunities, given that the business appears to have stabilised, or do you still see enough organic opportunities out there?
No, absolutely. So I think for the last 12 months, we have been talking about our own IP. So we do want to make sure that we own our own destiny in terms of that technology build. And so, yes, acquisition is absolutely on the radar. And the great thing about having a balance sheet and showing the performance over the last 9 months, funding options are vast. So debt is a possibility now. It wasn't a year ago, and at good prices. As the RBA obviously have just and increased that offering as well. So for the right opportunity, we could raise capital, but it's not my preferred. I'd much prefer to go into debt at the moment to drive a really good acquisition process when the price of debt is what it is.
No worries, Pat. Now that's all the time we've got for questions for the moment, so I might pass back to you, Pat, for any closing comments.
No, really, thank you, Tim and NWR, for inviting us in. Look, the presentation will be shared. My phone number will be at the bottom. And if you have any questions or interest, please don't hesitate to call. And I thank you very much for listening early on a Friday morning.
Thanks very much, Pat. Thanks everyone for tuning in. Cheers.
Thank you.